Tonight on Market Call, John DeGoey, Vice President at Burge-Invest BIC Securities. He'll be taking your calls and emails on personal finance, he loves those questions, and exchange-traded funds. Good evening and welcome to Market Call tonight. I'm Mark Bunting. Thanks a lot for joining us. You can call us toll-free as usual at 1-855-326-6266, or you can send us an email if you want to talk to John DeGoey about personal finance and or ETFs. Market Call at bnn.ca. Best of the season to you.
And to you.
Nice to see you.
Yeah.
Now, let's look ahead to 2011. What kind of themes do you see developing for next year?
I think one of the things that you can look at fairly broadly is commodities will continue to do fairly well. So that's the one thing that I think is, and you'll see that when you get into my picks as well. But beyond that, I always preach, cheap, pure, broadly diversified, tax effective when you're building your portfolio. So whatever it is that whatever asset classes you're investing in, look for things that are cheap, pure, broadly diversified, tax effective. I don't think we should expect, I'm not really big on prognostication. So those are the themes that I sort of dwell on in 2011, but also in 2012 and 2013. I'll be saying the same thing.
But the one thing that you are mentioning are commodities, and you say that they're often negatively correlated to other asset classes. And are we kind of seeing that right now, or not really?
Yes, we are. In fact, what we're doing is we're seeing commodities sort of jump into a lead right now, whereas equities have done not badly in 2011. Thank you very much. In 2010, they actually did not too badly in 2009 as well, at least for the last 3 quarters. But right now, if you want to look at where the really sexy growth has been in the past 2 quarters at least, it's been in commodities and tangible items in general.
Is that not a bit of a dangerous one-way bet in terms of the U.S. dollar weakening, which it has been for a while, the last few sessions anyway? Is it dangerous to be too far on one side of the ship, so to speak?
In my opinion, no, because the Canadian dollar and the U.S. dollar have been hovering pretty close to parity for a while, and we're sort of touched on it once, I think, already this week, and I wouldn't be surprised if it continues to hover at around parity. So in spite of what you say, which is true about the relative weakness in the greenback, I'm not super worried about it going much further in that direction. Meanwhile, the real driver of hard asset demand is coming from emerging economies. So it's really India and China and so forth that are driving the demand for commodities.
So there's the real demand, and then there's some speculation, some investment demand as well.
Yeah. But I think there's enough genuine real demand that I try not to worry too much about the speculative bubbles that might exist. Notwithstanding gold. Gold is the one thing that I think it might be starting to get a bit speculative.
And silver?
I don't think so.
Oh, no?
I'm not too worried about silver.
Why do you say that?
Just if you look at it, relative valuations in terms of the price of gold relative to the price of silver, right now, silver based on historical highs, not nearly as high as gold has been based on its historical highs. So I think there's still some room there, even though silver's actually gone up a lot more than gold has in the past year.
Now, you say you don't prognosticate or make predictions, but what do you see as being the risks next year? What frightens you? Anything?
I think there's a fair bit of risk with regard to sovereign debt, especially in the Eurozone. So a lot of problems with Greece and Spain and Ireland and that sort of thing. So I think in terms of debt, a lot of what I tell people is, right now, probably not a great time to have sovereign debt. I mean, if you can, unless you want to go all the way over to emerging markets, which have their own risks, but maybe a good time to be into corporates, because actually companies have done a better job of managing their balance sheets than countries have. So there's a risk in terms of sovereign debt, country bonds. I think beyond that, we've had a good 2 years, or at least a year and 3 quarters, and I think markets are now fully valued. I wouldn't call them frothy, but is there a risk of a 8 or 10% pullback? Yeah, I can see that happening.
And having said that, what you try to do for your clients and what you recommend to people is to as you say, be broadly diversified, but also in a regional sense and, as I remember, 6 different asset classes.
Yeah, within and throughout asset classes. So as I say, so if you're going to have Canadian equity, great. Lots of people have Canadian equity. But don't just hold 3 or 4 stocks. If you buy a basket, like an ETF or even an actively managed mutual fund, you'll have 20 or 30 or some cases 200 or 300 companies in that one single purchase. So you're diversified within the asset class of Canadian equity, but also throughout asset classes. So the 6 that I use, income, which can be Canadian or foreign, it can be government or corporate, it can be short-term or long-term, it can be nominal or high yield or real return, but income. Tangibles, which includes commodities, but also oil and gas and real estate and gold and that sort of thing. And then on the equity side, Canadian, U.S., international, and emerging market. And so if you have a portfolio that's built with at least some exposure to all 6 of those asset classes, you're not likely to have the sexiest story to tell when you're at a cocktail party with your friends, but you're also not going to be the one who's going to be crying in his beer either.
Right. All right, very good. John DeGoey is here, as you see, and he'll be taking your calls and emails right after this on personal finance and exchange-traded funds.